All right, guys. So you want to buy puts, right? You want to long a put. What does that entail? Buying puts. So when a short says, hey, I'm shorting a stock, this is most likely what they're doing because it's the most simplistic play a short can make, because it only requires buying a put, and it reaps great benefits if the stock price decreases and it surpasses the break-even point. It reaps great benefits, and the losses are constrained as well. So let's just examine this put contract we are buying. So because we are buying, it costs us the premium. So it's $65 to buy it. That's the premium. These numbers aren't in line. They should be. It's after hours, so there might be a little discrepancy in prices for the premiums. But it costs $65 at the end of the day. And the reason why it's 65 and not 65 cents is because there are 100 shares encompassed in every contract. So you multiply the 65 cents by 100, and you get $65. Sorry, I'm sick. That's why I'm coughing. So let's look at these key points here and see how we can calculate the break even, which is very simple. So the break even Robinhood is displaying here is 52.17, and that is calculated by subtracting the strike price of the contract you bought by the premium, which is 65. So 52.582 minus 65, 52.17, right? Yes, yep, 17. So now you know the break even. It's very important because if the price of the stock goes below the break even, you know for certain that you are making money from this contract. And what you do is you sell the contract, you sell the put to collect the money. So you want this buy put, this long put, to essentially appreciate. You want it to appreciate. Anytime you're longing something, you want that contract to appreciate. So it appreciates by the stock price decreasing and surpassing the break-even point. So what's this point right here? Well, it's very apparent that this point is the strike price. So this point here is strike price. So if it goes below the strike price, the stock's price, just a portion of your premium will be lost. But if it goes above, anything above the strike price, hey, you're just gonna lose your premium. You're gonna lose the $65 in this case, which right now this is the current point we are at. And if we just bought and then sold, we would just lose the money, right? But we don't want to do that. We want this to surpass the break even so that we start making profits. So what's great, a pro about long puts, what's really great about long puts is that if the strike price hypothetically goes to infinity, we just still lose the $65. We just lose the premium, right? Anything that surpasses the strike price is just the loss of the premium. So it's great. So let's go far in the money, and we can see that it's very conspicuous that the price of the premium is increasing. So with the increased price, it costs more. So this costs, almost $3,000 to buy this contract. But by buying into this contract, you start at the break even. Whereas if you went down here out of the money with this put, look at the distance between the current position you're at and the break even. And ultimately what you want to do is surpass the break even, go below it, so that you start making money. So you want less distance. So there are trade-offs, right? This contract costs less, but it requires more movement because there is more distance compared to far in the money long put contract, which you essentially start at the break even. I think almost at the break even. Perhaps if I select this one, it will be the break even. No. Okay. So yeah, a slight, but also when you buy a contract that costs this much and you start relatively close to the break even, A slight decrease in the stock price will bring about instant profits, but a slight increase will bring about instant losses. So it's just the bet. It's how much risk you want to bring into your portfolio, but also if I bought this contract, it's good to know, if it increases in price, you're still losing the premium, and it decreases a little in price, you're still losing money. So it's up to the investor on how much risk they are comfortable with introducing into their portfolio. That's pretty much it for this video. Thanks for watching.